Hey, Dan Passarelli here. Well, we all know that the market is unpredictable. Most people wouldn't have predicted what the market has done over the last month or two. Some may have thought this might have happened, but nobody can accurately predict every time what the market's going to do. Let's just face it. But that said, I have gone on record, especially to our total earnings domination students, of talking about implied volatility. And one of the things I specifically say is, look, I have no idea where a stock is going to go. No one really does. I can do my analyses and be right some of the time and wrong other times. But one thing I feel that I can predict rather well, as can most of our student traders who have taken the total earnings domination course, is volatility. And I've been watching volatility for years. I have a really great feel for how it works. And here's what I think is going to happen going forward as far as the market's concerned and in the context of volatility. So the VIX, when I'm shooting this about an hour and 15 minutes before the close on Friday, it was at 2974. Now that's a pretty high level, and it's been up for quite some time. Okay, for a good almost about a month, it's been around that 30 level, give or take. So one of two things is going to happen. Either A, if the market heads higher, the implied volatility level is likely to come off a little bit. By that I mean get a little bit lower. It'll probably level off at about that 25 level and not go that much further, because we still are going to have the same scenarios playing out over the next several months. The inflation is not just going to disappear next month. And that means that the prospect of raising interest rates is not going to disappear. And if it does disappear, I mean, it's not going to disappear, but if it changes, then that's just going to cause even greater volatility. So the implied volatility level is likely to stay high for a while, even if the market goes up, which is going to be really great for income trading. Now, if the market goes down, that's where things can really get a little bit tricky, because with the implied volatility all the way up here, what can happen and sometimes does happen is what's called capitulation. And that's when people who have been really sweating it out and saying, I don't know, should I sell my stock? I've been really nervous about the market. I don't know, maybe I should sell, maybe I should sell, maybe I should sell. And the market finally heads lower and can get some follow through. That's when the implied volatility level can really explode. That's when people really start selling their shares, and that causes a bigger move down. That causes more people to sell their shares. It's called capitulation, which is sort of a long fancy word for surrender, giving up. And when that happens, that's when the implied volatility level can really explode, and that is the time to look at and consider selling puts on stocks you want to own and selling put credit spreads on trades. Now, it's definitely a lot more speculative in the short term then, but in the long term, I will say in my experience, it has worked out 9 times out of 10 on average. We as option traders, we thrive on the fear of others and figure out how to capitalize on that. When everyone else panics, that's when we can step in and take advantage of the situation. And that's where we can really shine. I hope this is helpful. I hope that makes sense. Pick your spots carefully. And hey, have a really great weekend. This is Dan Passarelli. Trade smart.